Hello, I'm Monique Gravel, the CEO of Claret Asset Management. This video is part of a series created for clients of Claret as an overview of the markets in 2020 and how we view things going forward in 2021 and beyond. In this video, I'm hosting a panel with Claret's partners, Alain Chung, William Kovalchuk, and Jean-Paul Giacometti, where they will answer the burning questions we receive from you, our clients. So without further ado, I'll start with Alain Chung, Claret's chairman and chief investment officer. Alain, can you answer a question that many of our clients asked? What is Claret's strategy and how did it pan out in 2020? And what will you do differently in 2021?
Thank you, Monique. Over the long term, we can view the pandemic as a watershed event that will change the world forever, from the way we interact with each other and the way corporations see their employees' productivity. But in terms of portfolio composition and future strategy, we don't think it should change much. The end game is still to find companies that possess unique characteristics, giving them an operating advantage, allowing them to achieve higher profitability, and we try to buy them at a reasonable price.
What exactly are you looking for in your analysis?
Among the many characteristics that make a company successful, we try to identify the ones we believe we have a better understanding of based on our experience. Notably, companies that have a well-defined business strategy and that are highly focused, companies that relentlessly improve their client services or the product they offer, companies that have pricing power over the good and service they offer, and business they are picks and shovels provider for growing industries. In general, business that are generally qualified as asset light. Let me explain. The term asset light, companies need to invest heavily in equipment and plants are not considered asset light. Business that rely on intellectual property, spending in R&D, good clients relationship are usually considered asset light because these assets, although very real, sometimes do not show up on the balance sheet as a number, therefore the term asset light.
Another question was asked by a longtime client and friend regarding our change of heart on technology companies. Why has Claret had a recent change of heart when it comes to technology?
To be sure, we're still trying to avoid companies that operate in industries we have a hard time understanding. That being said, we've been following the high-tech industry for the past 20 plus years now. As the industry evolves, we realize some of these companies that used to be called tech companies are actually consumer-oriented companies. They make money the old-fashioned way, get the consumer to spend money and then take a cut on that spending directly or indirectly. They also make sure the consumers are hooked on their product or services one way or another. While the money-making process is slightly different than traditional businesses, in the end, consumers are paying for the goods and services they're getting.
Can you give us a couple of examples?
Of course. Take Amazon, for example. It was basically an electronic version of a bookstore to start with. Then they realized they can sell other products. Later, they realized that they could also allow other merchants to sell things through them for a fee. And then they add more services like fulfillment and inventory management to make life easier for those merchants, of course for another fee, and so on and so on. As you can see, it is very consumer-oriented. Other example would be Google and Facebook. They collect users' data from people like you and me through our search, and monetize them by selling targeted ads. Another example would be Microsoft. They used to sell software products, period. You had to buy new version as they produced updates. Now, they're selling the same software on a subscription basis, and you don't have to pay for the updates. You don't own the software either. You basically rent it, and you pretty much have no say on the rent. And God knows it's not so easy for you to change software. Last but not least, Apple. It basically owns an ecosystem where the users of all Apple products swear by Apple. So the company creates a platform when the users can get as many goods and services as they want without ever leaving it. And for any goods and service the user buys, consumer buys, Apple will get a fee.
So I guess that's not really a change of heart then.
Not really. As we learn more about the evolving tech industries and we get a better understanding of the different profit driver, we have added these names to our portfolios. But let me emphasize one thing. We still try very hard to stay away from unproven, innovative companies that are either not yet profitable, it may never be, or profitable but at nosebleed valuations. Some cases, we no longer talk about multiples on earnings, but earnings on revenue, and some don't even have revenues. They're very hot these days. It's quite reminiscent of 1999 and 2000.
Well, we've been asked why we'd not invest more in the new economy companies that have powered this market over the last few years.
Well, for those who were around during the internet bubble, we had been asked the same questions. The answer revolves around price and value. Quoting my hero Warren Buffett, who wrote, "Price is what you pay and value is what you get. Which would you prefer to have, price or value?" We still believe value is a better long-term investment approach. It's just that we define value differently from what you read on the financial newspapers. For us, it's not about some ratio like price to book or price to earnings or high dividend yield.
So, how do you define value then?
Well, it's more about what you get for what you pay. There's an endless debate regarding value investing and growth investing. For us, we believe value and growth are joined at the hip. For us, investing, it's about the act of seeking value that we believe exceeds the price we pay. Therefore, growth is always a component in the calculation of value. By the way, the definition of value has also evolved with the structural changes of the economies and the accounting standards. Physical plant and equipment used to be the most important assets in company. Today, intangibles such as intellectual property, client relationship, R&D are becoming the most important assets in healthcare companies, for example, software companies, many others, including manufacturing companies. Coming back to the question regarding the new economy, the answer to your question, it's when prices are right, we will invest in profitable companies, whether they are in the so-called new economy or not. As a side note, when you talk about new economy, you automatically imply innovation. And on this topic, I like to remind myself once in a while Warren Buffett's best bits of wisdom regarding the question of innovation. He wrote, and I quote, "As investors, our reaction to a fermenting industry is much like our attitude towards space exploration. We applaud the endeavors, but prefer to skip the ride."
Thanks, Alain. Let's put Bill on the hot seat with the next set of questions. William, Bill Kovalchuk, for anyone who hasn't met him, is president and portfolio manager at Claret. Bill, you co-founded Claret 25 years ago. You were Claret's first employee in 1996. How has value investing changed over the years?
Thank you, Monique. Ultimately, when you analyze a company, you want to know three things. First, how much money do you need to start the business? Next, how much money will the business produce each year? And finally, how much money do you need to reinvest to keep the business going? The idea of fundamental value has not changed. Companies have an intrinsic value. When their stock price falls below the value, you buy them. And when the price rises above that value, you sell them. Value investing is a concept that was created in the 1930s by Benjamin Graham after the industrial age with tangible assets. The new consumer industries such as banking, insurance, furniture, household goods were created, including grocery stores. Therefore, using book value was very appropriate as a metric. It was also appropriate because companies operated within their nation states. And that's why you have two companies today, both named Merck, one in Germany and one in the US. Today, entirely new sectors have been created, which include biotechnology, communications, and high technology, hardware and software. Companies are international, and governments compete for corporate tax dollars. So accounting has had to evolve from cash to intangible assets. When it comes to value investing, intrinsic value, the more things change, the more they stay the same.
But is value investing dead, as some have suggested? Or is it more like what Mark Twain was saying, the reports of my death are greatly exaggerated?
Well, back to value investing. Traditionally, value investing means buying a company at a discount to its intrinsic value and having a margin of safety, a margin of error, just in case something goes wrong. So we like companies that pass solvency tests, have free cash flow, and sustainable gross margins. At Claret, we believe free cash flow is extremely important as it proves that a business model works, and no external financing is required to maintain that business. You only really have a business once you have free cash flow being produced. Until your business produces free cash flow, all you have is an experiment that requires constant money infusion and burns cash. If you stopped injecting cash into the company, it would go bankrupt and require restructuring. Think of WeWorks or We Company. That's what happened to them when the music stopped. So value investing is not dead, but companies that never produce free cash flow do eventually die or get taken over for pennies on the dollar.
So are value and growth completely different animals?
Ideally, we want to buy companies at a discount to their intrinsic value that have growth characteristics. Over the years, such companies have included Dell and Paladin. These companies were growth companies temporarily in the doghouse, in the penalty box, and eventually recovered nicely and were taken private or taken over. Growth companies stumble for various reasons, such as unachievable expectations, obsolescence, new technologies, new government policies, accounting shenanigans, and competition. And the stock price tends to fall dramatically. After they stumble and stabilize, some become wonderful value picks, fallen angels. We have companies that have cycled between value and growth and value again, such as Coke, Microsoft, Intel, Cisco, Tractor Supply Company, and most of the large pharmaceutical companies in the US. Remember, markets are always forward-looking, so from a value perspective, a stock price equals the future cash flow of a company's discounted over time. So the demise of value investing has been greatly exaggerated.
Well, thanks, Bill. Now over to our other senior partner, Jean-Paul Giacometti. We have several clients who have asked about macroeconomic factors like interest rates, economic growth, stock markets, etc. What's your crystal ball telling you, Jean-Paul?
Well, thank you, Monique. My crystal ball tells me a lot of things. It tells me that doing predictions is like a game. In fact, some call it a pointless exercise. Who really knows what's going to happen 10 years from now? I mean, there's so many variables. You can be right for the wrong reason, vice versa. It's so far away. But I'll give you one trick, though, to be fairly often have good prediction fairly often.
And what's that, Jean-Paul?
Well, you better do a lot of predictions.
What factors have the greatest influence on Claret's choices?
Well, let's take three that are current. Let's say low interest rates are very good for the stock market. You have also massive injections of liquidity by the central banks. That's good. And you also have government spending, which of course stimulates the economy. So all these factors put together are very good for the stock market, but I must add to a certain degree though.
What do you mean exactly?
Well, if you push it to the limit, and you start printing and giving money all over endlessly, money eventually will have no value. True, the central banks can control short-term interest rates, but can they really control long-term rates forever? Can they buy bonds forever? No, probably not. So investors might, on the long run, require some type of return for their long-term bonds, especially with the government spending so much and with the debts going up so much.
So is all this predictable?
Well, with hindsight, I can tell you it's going to be very easy to explain what happened, as usual. But looking into the future with all these thousands of economists and analysts, well, somebody will be right, probably more than one. The only problem is, can you identify whom before it happens? That is this question.
Well, as you say, Claret is often referred to history to help explain the present. What elements of history might help explain where we're at today?
Well, they say that history doesn't repeat itself, but it often rhymes. So we tend to look back at times when things look similar, and we went back to the Second World War. During the war, money was printed to boost the economy. The governments were spending. Also, there was the war activities. So the market was climbing, especially in the last years of the war, still during the war. In fact, it kept on going for a while after, until 1946. Then things slowed down and went back to normal, less printing, less activity, and we had 3 years of stagnant market. No big crash, but nothing exciting. So if we look today, well, today you have about the same thing. The pandemics going on, and you have printing of money, spending by the government, and then the vaccine will come out. Now, if they stop printing and if they stop spending like before, then might be some boring years coming up ahead.
Right. So, what's the solution to help us through all this?
Well, it's a good question. In fact, the solution lies on a good strategy, or good methodology, I must say, and a good philosophy. A philosophy that has had success over time. And as Bill talked about it, I can just emphasize that we tend to spend a lot of time on companies that have good free cash flow, a good positive free cash flow, which means they generate money after their expenses and after their capital spending. In other words, they stay alive. And these companies, you have to concentrate on them in bad times. Just to give you an idea how easy it is in good times to invest, there's an old saying in finance that says, when the wind's strong, even the turkeys fly.
Well, what about things today that weren't an important element historically, like ESG investing, and more particularly, the environment?
Well, the environment is important. Environment is our future. So when we talk about it at lunch or at the office, we kind of agree that the best way to have an impact on the environment, social issue governance is through the actions twofold. First, through the actions people take, either by consumption, when they consume, what they buy, or also the way they act. And the other way is to make sure you vote for governments that propose or pass good laws that help the environment. So that's very important. Us at Claret, basically what we do is we respect the laws. We don't try to push forward our preferences into the portfolio.
Yes, but can our clients reflect their preferences in the portfolios?
Good question, sure. There's two ways to put your preferences in the portfolio. Put it this way, there's the active way. A client can say, I have sectors I do not like and I think they have a bad impact on the environment. So for example, they can say, I do not want any oil companies in my portfolio. That can be done. It can also be done on the individual aspects of the securities and say, this security, I do not like it for reason XYZ, governance, social environment, whatever, and those will be excluded from the portfolio. So these are the two ways that are done, but in the course, over time, these preferences or wishes can change at any time.
And what is the second one?
The second one would be more of a passive way. There's lots of funds in the market that attack or address this issue of environment, governance, and even they sometimes combine two of these issues together. They basically build these funds for marketing purposes. They sell well. So what they do, they have criteria. They follow their criteria, and they build their portfolio. Of course, you have no say in the building of the portfolio or whatever is happening in the fund. But you have to be careful of one thing for certain circumstances, is that the expense ratios can be high, so 2 or 3% higher. So the conclusion is that it's not a perfect solution, but it's a solution.
Thanks, JP. Speaking of funds, I'd like to bring the conversation back to Alain. Why has Claret added pooled funds to our asset allocations in the last several years?
Well, as our research evolves, we have gained more insight regarding the relationship between stock prices and companies' business performance. It is well known that the correlation exists between a company's profit performance and stock price over the long term. What is interesting is that depending on how you measure a company's business performance, that correlation has better predictive power. We also realize that its investors are more emotionally affected by the news report in social media and other related communication media. Portfolio diversification is becoming more and more important. So by using a disciplined, quantitative approach to investing, we have created several pool funds to allow our portfolio managers to better tailor their clients' assets to their respective investment objectives.
And are there some specific benefits in investing in these pooled funds?
Yes. First, they offer better diversification when a portfolio is smaller size. Second, they offer access to a much broader diversification within an asset class where market inefficiencies are more pronounced. The Claret Income Fund would be an example. They also help clients avoid constant focus on individual names in the portfolio, and they especially help clients and portfolio managers focus on needs and goals instead of news and volatility. These pool funds are the result of our analytical research over the more than 20 years, and we have confidence that they will perform quite well over the long term. You can ask your portfolio manager to show you the testing we use, the academic data behind the research, and I'm sure you will understand, as we do, the potential of their long-term performance. Let me tell you something very unique about our funds. We have designed them just for our clients. There are no additional management fees, no administration fees, and no audit fees. Claret covers all these expenses because you pay us to offer you the best investment structure. As for the client who still desires to have their portfolio managed in a segregated basis, nothing has changed. Claret funds are just an alternative or a complement.
Can you give us an example of one of Claret's pooled funds?
We created a fund that invests in smaller companies. It's called Claret Small Cap Funds. It aims to take advantage of market inefficiencies in the world of small companies. There are many characteristics that are unique in the small cap world, and some specifically to the Canadian small cap market.
Such as?
Well, first, there's a lack of liquidity in this market, especially when it is bad. It's not easy to buy and sell without creating a lot of price fluctuations. However, as volatility means opportunities for the well-informed analysts, it allows us to buy companies at valuation that are sometimes way below intrinsic value. Second, in Canada, they're the mega-sized public companies where most money is invested, especially for the portfolio run by institutions. Then there are the small-cap companies, too small for the institutional crowd to be bothered with. In a sense, it means that small caps tend to be undervalued sometimes because of neglect.
Anything else?
Well, investing in small cap does require a fair amount of diversification, so the investor does not end up focusing on a specific name. Therefore, a fund is the most appropriate structure to take advantage of these opportunities.
Well, Bill, Alain just mentioned small cap stocks in our small cap pooled fund and how these smaller companies are sometimes less liquid and therefore subject to volatility. We hear about the term volatility all the time, and clients have asked about it as well. You used to be a bond options market maker on the floor of the exchange, dealing, of course, with volatility. Is volatility a good thing or a bad thing?
Volatility is part of every system. The definition of volatility is the ability to change rapidly and unpredictably, especially for the worse. The context is usually negative, unfortunately. But think about your car, a gasoline engine. You run on controlled explosions of gasoline. Gas is volatile to create power to move your vehicle, so that's a good thing. In finance, the definition of volatility officially is that squiggly price line you see on your screen. And you need to know that volatility and liquidity move in opposite directions, like price and yield for bonds. That might be too technical. Think of dogs and cats that don't like each other. When volatility comes into the room, liquidity disappears. It runs and it hides. In finance, think of the 1998 Russian default crisis. Russia created volatility and liquidity on bonds around the world disappeared. Locally, Seagram's and other companies who were solvent and solid had no bid. Nobody wanted to buy these companies. There was no liquidity. It was fear, fear, fear. And that created opportunity.
Well, what about all the talk about private assets? Private equity, private credit, venture capital, even real estate is having low volatility and therefore considered to be safe. What do you say to them?
Measurement, or the number of times you measure something, has a lot to do with volatility. For example, if you had two apartment buildings side by side, exactly the same, and one was publicly traded and one was privately owned, what would be the volatility of each of those buildings? Well, the first building is publicly traded, and so you would have prices changing hands every day and a squiggly line associated with it. The privately owned business might ask for a valuation on January 1st and perhaps another valuation on December 31st of that year. So two dots connected in time with a straight line. That asset appears to be very low in volatility. Is it really more boring, safer, less risky? Not at all. Another example from a personal perspective is your home, condo, or cottage. If you put the equivalent of a gasoline station sign right in front of your building, your house, it would go up and down in value with interest rates, recessions or booms, and lots of other variables, including location, location, location. So often people will refer to private assets such as venture capital funds, private equity funds, real estate, infrastructure, and some hedge funds as being low volatility. You need to wonder exactly what they're talking about. Who is measuring this and how often versus a comparable publicly traded company or bond that trades every day and where liquidity is readily available. Just because you don't measure it doesn't mean it's not volatile.
So let's bring volatility back to Claret and the investment process. How does that work?
So as people already know, we're disciplined value investors using fundamental analysis. We like solvency, free cash flow, and gross margins. What does that mean in everyday volatile trading markets? Think about driving your car in wintertime. Roads might be clear, snow-covered, icy, or closed, and forecasts change without notice, creating volatility. At Claret, we drive with winter tires, four-wheel drive, and studded tires. We need winter tires like solvency before we even want to go outside. If a company doesn't pass solvency tests, we don't need to go there. Free cash flow provides our four-wheel drive. We can go anywhere and get through conditions including recessions and downturns with our free cash flow. And finally, we want stable gross margins to keep us steady on icy conditions when competition heats up in an industry. At Claret, we believe opportunity equals homework plus volatility. You must do your homework ahead of time, otherwise when volatility sets in, it'll make you make defensive decisions which usually turn out to be wrong. If you do your homework ahead of time, when volatility arrives, you'll be able to recognize your moment of opportunity. Remember, what you own is cash flow, what gets measured is price, and what gives us opportunity is volatility.
Thanks, Bill. Now I have a question for Jean-Paul. How does the subject of volatility square with the idea of portfolio construction for those who will retire in, say, 5 years' time?
Well, retirement is not the end of a period. I mean, it's a continuation, it's a transition in your life. So retirement, when you get there, you still have another 30, 40 years to go. Generally, or not generally, but often people build in their portfolios, or it's built in the portfolio, these investments to generate revenues. So it's either through interest, dividend, capital gains. But you don't need to build the whole portfolio only with instruments or securities that generate interest and dividends.
Okay, but what's the optimal asset allocation?
That's a good question. Well, most would say that you have to have a forecast on what would be the interest rate in 10 years from now, dividends, stock market performance, but who knows whether it's going to be in 10, 15 years. So we used a different approach. We went back and took 30-year periods. 30 and 40 are the same. So we started in 1914. That's where the data starts. So 1914 till 1944, 15 to 45, so on and so forth. All these 30-year periods. And we're not looking for an average, okay? We took the real numbers, the inflation numbers, the interest numbers, dividends, everything, and all incorporated to find out what's the optimal portfolio for these periods to live off. So we're not looking for an average, because average once out of 2 times, you don't get to the average, so you don't aim for that. Or just another general image is you can have your head in the freezer, your feet in the oven. On average, you're okay, but are you really that okay? So what we're looking for is the worst periods. What is the worst period that you need to go through to build a portfolio? And so if you aim for the worst, not that worst won't happen, it's just that the odds are it'll be better than what you're aiming. So it's easier to go that way than downgrade. So we went through time and looked at all these periods and tried to find the worst period.
And what did you find?
Well, we found that in a portfolio, the more fixed income you put in the portfolio, the less likely you are, in fact, not you, the less likely the portfolio will survive the 30-year period. Well, of course, unless only if you withdraw 1% of their portfolio per year, then that's not a problem. And on the other hand, the more equity you put in the portfolio, the better your results are over a 30-year period on all the periods. This, of course, takes into account inflation when you do your withdrawal, and this also starts with a 5% withdrawal initially.
Okay, so does that mean you suggest 100% in equities?
Well, not quite, because 100% equities, a lot of people won't like that when the crisis occurs. So even though I suggest, or the history suggests, that 100% equity is the best, if there's 3 heart attacks from the beginning to the end, it's not a good idea. So fixed income should be included in the portfolio. But don't remember, though, that at the bottom, at the end of it, the important thing is you're going to have to maximize returns and minimize the sleepless nights when you do portfolio management.
Thank you, Alain, Bill, and JP, and thank you at home for watching. We hope that answered your burning questions. If you have any more, please reach out to us and we'll follow up. If you're watching this in order, up next I speak with Vincent Fournier, who we call Next Gen in spite of being with Claret for more than 18 years as a portfolio manager. We'll be talking a bit about RIFs and fixed income strategies before he leads a panel of the Next Gen portfolio managers in a lively discussion. I hope you'll stay tuned.